Chidambaram has kept his word. The finance minister today pegged the fiscal deficit for the current fiscal year at 4.6%, well below the promised 4.8%, promising, in fact, presenting the interim budget, the last before the general election. The FM said GDP will grow at 4.9% this fiscal. He also doled out goodies for battered sectors like automobiles and capital goods with big cuts in the excise duty.
Keeping the ensuing elections in mind, Chidambaram struck a chord with the defence personnel, clearing their long-pending demand for one rank, one pension. The finance minister may have walked the talk on the macro front, but questions have been raised about the quality of the numbers he's produced. So has the finance minister delivered, or is it just financial re-engineering at work? That's a big story on Business Tonight, right here on Agenda 2014.
We have a power-packed lineup of guests joining in on Business Tonight this evening. Who's who of corporate India and government? Firstly, Swaminathan Aiyar, consulting editor of ET Now. We've got Mr. Arvind Maram joining in live and exclusive on ET Now, Secretary, Department of Economic Affairs and one of the key architects of this budget. We've got Mr. R. Seshasai, Vice Chairman Ashok Leland joining in live from Chennai, Shikha Sharma of Axis Bank and Rajiv Memani of Ernst Young as well. Swami, before we get a quick take from Mr. Maram, I want your view on the budget. You wrote in the paper today that hopefully Chidambaram will be able to pull out a rabbit from his hat. What's your assessment of the budget? On the face of it, the numbers definitely look impressive.
A vote on account is supposed to be a non-dramatic event, and I would say it is a non-dramatic event. He has done a little bit here and there. There are some minor cuts in for autos, for mobile telephones, things like that. The broad parameters, he was expected to have a fiscal deficit of slightly below 4.8 and below 4.2. He has delivered. I mean, this is not something aimed at the election. It is not aimed at the voter. He is not trying to buy votes. Rather, I think he has been trying to impress foreign investors and the rating agencies, saying, look, I know we have deep problems here, but please don't downgrade India. Give us a chance. We are on the path of fiscal virtue. Therefore, do not do a downgrade. From his point of view, the electoral point of view, the worst thing would be a downgrade, because that would mean a crash in the rupee and a sharp rise in inflation, both of which would be very bad for electoral prospects. He has definitely ensured that is not going to happen, and that is a more responsible approach, I think, to fiscal finances than trying to buy voters with various sops.
All right, that's the word coming in from Swaminathan Aiyar. Let's take it to one of the architects of the budget, and that's Dr. Arvind Maram, who's joining us live right here on Agenda 2014. We appreciate being with you. If I may take the argument forward, this isn't a populist budget, and which is why people are breathing a sigh of relief. This is a pragmatic vote on account. You have achieved the fiscal deficit at below the target level at 4.6% actually. How satisfied are you with the fiscal adjustment that has been made this fiscal? People like the headline number, but they're a little nervous about what has gone within that.
I think we have managed to keep within the target, which had been established to be at 4.8% for this fiscal. We are below that. But that was expected because the government's commitment to continue on fiscal consolidation path has never been weak. We believe that the numbers that we have given are credible, and therefore there should be no doubt on account of not only the resolve of the government but also the numbers that have been given.
I don't think, Dr. Maram, anyone's going to doubt the credibility of the government and the finance minister as far as fiscal consolidation is concerned. But Swami, I want your quick take on the quality of fiscal consolidation. The fact remains that the rollover of subsidies, fuel subsidies, is only 35,000 crores. That's actually lesser than what we saw in the last fiscal to this fiscal. So contrary to what seems to be the overall theme in the market, do you think the quality isn't as bad as it potentially could have been? What's your reading on the quality of fiscal adjustment?
Adjustment is certainly down. If you see the revenue deficit, it's still pretty high, 3.3%, going up to 3%. This was supposed to become zero. by 2016-17. Frankly, on the current trends, I can't see that happening. So that's one measure of the quality of the fiscal adjustment. You will find that this particular year, the planned spending was well below target, whereas non-planned spending exceeded the target. Again, it's an indication that the quality of adjustment is not particularly good. To me, one of the main issues is if you cleared 6.6 lakh crore worth of projects, and if that is not translating into orders for capital goods and construction, to my mind there is a huge, deep structural problem which cannot be papered over by optimistic projections. There are some very serious problems structurally which is preventing the economy from gathering steam. And if the economy does not pick up, we are not going to have this 6% real GDP growth next year that the government seems to be hoping for. So, I mean, unless something is done on that structural side, I think many of once again we will find that next year you find at the last minute, Are bhai, I have to cut various kinds of expenditure. The simplest thing is to cut the planned spending, so we get a poor quality.
Let me get a quick take from Shikha Sharma as well, Johnson from Corporate India, CEO MD and MD at Axis Bank. Shikha, what's your reading? Do you think the finance minister has resisted the temptation of being populist? And in a sense, this vote on account is a responsible, credible statement aimed at rating agencies? Would that be your assessment as well?
I think what we've seen over the last year since Mr. Chidambaram took over as FM is a sharp focus on consolidation, both fiscal consolidation and the current account. And that's yielded results clearly if you look at the numbers that have happened. And I'm sure all of us are relieved that the VoA hasn't done anything to reverse that. In any case, I'm not sure whether populist measures done at this point of time was going to impact election outcomes in any significant way. So I think it's a positive for the economy that we have kept that sharp focus on stability and fiscal discipline.
All right, focus on stability and fiscal discipline is the word that's coming in from Corporate India. Let's get in a very special guest, Mr. R. Seshasai, who joins us live right here on Agenda 2014. Plenty of SOPs for your sector, at least as far as auto is concerned. Excise duty cuts. Do you believe two things? Will this boost manufacturing and in turn boost consumption? And could it not have come in a little earlier? If all of this was in plan, this could have perhaps come in and not waited up until the 17th of February. Mr. Seshasai.
Well, I think the intervention certainly has been most needed because the manufacturing industry has been languishing, and in particular the automobile industry, commercial vehicles included. And to that extent, this intervention is most welcome. But I think the larger question is that is this going to stimulate growth, and are we going to be looking at manufacturing having a reasonably robust growth for next year to support the expectation of 6%? That, to my mind, is a big question mark. I don't think that we have as yet a momentum in the economy, notwithstanding the fact that the vote on account has been a reasonably good exercise by itself. I don't think that we have a momentum to say with any degree of certainty that we are going to be looking at a 6% growth next year. And manufacturing is a key element in this. I think there are many more things to be done, and I think this is hopefully is just the beginning, and the new government will take it forward.
All right, whether the new government will take it forward, we'll perhaps have architects of this budget like Dr. Mayaram to certainly see to it. Dr. Mayaram, if I may come to you, could this not have come in at an earlier time? I know you have said that there needs to be a predictability in what the government does with its taxes, but could it not have come in earlier? And what are the other things that will perhaps be seen to be done at least in the next 4 odd months to boost manufacturing, if that's really the rationale, if that's really the aim?
Actually, if you look at it, the concentration last year was more on getting the infrastructure projects going, because they are very capital intensive and a very large part of the bank finance was stuck with them. So you have seen that since January of last year till now, projects worth more than 5.5 lakh crores have been approved by the Cabinet Committee on Infrastructure. So therefore, it's very clear that we have moved in the direction of getting growth back. We have seen that that reflection also in the last 2 quarters. Now, it is true that manufacturing requires very focused attention. This is just a beginning. I think I agree with Mr. Seshasai that much more needs to be done. And I believe going forward we will be concentrating on the manufacturing sector. But I believe it's not just the taxes which are important in terms of manufacturing also. For instance, infrastructure deficit has to be removed. The transaction cost of setting up units, especially in terms of approval, time taken, etc., that has to be reduced. And going forward, we must work on that to get manufacturing back into focus. So there is no doubt that there is much work to be done, but I also believe that there is enough evidence to show that growth is clawing back, and moving forward in the next year, I certainly have no doubt that if we continue to work hard and continue to pursue the reform process which has already been started, then 6% is not beyond our reach.
Mr. Mairam, I'd like to take you up on some of this. To me, the most distressing thing is, when Mr. Chidambaram became finance minister, the idea was we are now going to accelerate, we are going to give a push to the economy. This was in the autumn of 2012. And the Cabinet Committee on Investment was formed as the vehicle for ending policy paralysis and getting together. And they cleared a large number of projects. 18 months later, there is still no visible impact on capital goods output or on the construction industry. So I said, if the decisions are not translating into orders, something has got lost in translation. On this, I have not seen any proper analysis. It was not foretold. Nothing has been done in the budget, as far as I can see, to solve that. If you find that even after clearing, he says 6.6 lakh crore worth of projects, that should give you huge orders for capital goods. And you try to compensate by saying, I will cut the excise duty by 2%. Very clearly, the problem is not that a 2% change in the price of capital goods will revive the industry. There is the translation of the decision making into orders that's not taking place. So what are we going to have there? Are we going to have a system that Rahul Gandhi talked about of deemed clearances, so that whether or not some Babu signs on the particular file, things will go click, 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 and people will actually then be able to translate decisions into orders.
Mr. Aiyar, you are asking this question from a Babu, as you just now said. The Babus kind of hold back fires. But on a serious note, I think what is important to understand is that there were large number of factors which came into play last year. So when the decision was taken to set up the Cabinet Committee on Investment in December of 2012, we did not foresee, for instance, that the scare of taper in May, for instance, will kind of create a run on the foreign exchange and the rupee will start tumbling down. Now, those were not foreseeable at the time when we were talking about unblocking the projects. So obviously, when the external sector became completely vulnerable, then the entire focus and attention had been to stabilize the economy, and while continue to move in the direction of getting all those clearances in place. So as and when the economy stabilized, investments will actually start happening without a lag, because we couldn't wait for first the economy to stabilize and then give the approvals, so that it would take another 8 or 10 months before the actual investments begin to happen. In the current year, if you have seen even the budget document, the public sector takings have actually invested close to 250 lakh crore into different projects, etc. Now, if you look at that, 2.5 lakh crore. And if you look at that, that certainly is one of the results of these clearances which have been given. And this is also being seen in the fact that the last 2 quarters, the growth has been higher than the growth has been in the previous quarters. Now, I accept your point that we need to do much more. There is no question about that. We need to continue to work hard. I wouldn't deny that. I also am a great votary of making decision making more predictable, which means that the decisions regarding approvals, etc., should have some finite time limit. I agree that we need to move in that direction. However, I would still believe that whatever has been done to stabilize the economy, to create a strong foundation in the last couple of maybe 2 years, is going to stand in good stead going forward in the next year and the year after that.
Well, Mr. Seychelles, I comment on that because, the fact remains, like Swami was pointing out, we've seen huge number of projects getting cleared by the Cabinet Committee on Investment. It was pitched as a breakthrough reform, so to say, and yet very little investment break ground. Why is corporate India shy of putting in big money in projects right now?
I think there are 2 very, very important reasons. One is the fact, and this is not really being recognized as much as it should be, and that is the fact that there is not enough equity in the market. There is not enough equity amongst the large industrial houses today for making fresh investments, because a lot of them are nursing the injury of investments made in the past few years, and therefore there is not enough equity or savings, corporate savings coming out of existing operations to fuel new investments. Nor is the capital market ready to support new investments happening. Nor indeed you have the foreign investors looking at the scene in India as being sufficiently welcome for them to come in. So I think this issue of a deficit in equity, the deficit in entrepreneurship actually at this point of time, I think is a very, very serious issue, and it's not going to get cured by making marginal changes in tax rates or whatever. The second is, of course, the fact that demand has been suppressed for the simple reason that in the last few years we have seen demand spike happening as a result of easy credit. Banks which were marketing credit, NBFCs, banks which are marketing credit, created the demand pull, and that therefore created the right environment for investments. Now the situation is that with the installment credit being more expensive, and the banks not resorting to marketing of credit, and the fact that consumers are staying away, making commitments for the future in terms of large installment payouts, the demand is certainly suppressed, and that's not a very encouraging situation for new investments to be made. Capacity in large swaths of manufacturing industry are remaining less than fully utilized, and I don't see therefore the investments taking place in a hurry anymore.
Expect a turnaround very, very soon, and that's an interesting point that you made there, Mr. Seychelles. Let's get in Shikhar Sharma as well. Shikhar, what according to you is holding back investment, and do you also believe that corporate India will be in a wait-and-watch mode till the new government takes charge?
So I think what is holding back investment is a disappearance of risk appetite, because people don't have clarity on what the policy is going to be like and whether there's going to be a review of decisions that have been taken in the past. So at this point, with an election very close, I don't think anybody is going to change their mind as far as risk appetite is concerned. We will certainly have to wait for the new government to come in and see what is the focus of the new government before any significant appetite for investments comes back.
All right, I really want to take this discussion away from investment and bottlenecks and really talk about policy. Dr. Mayuram, if I come to you, FM did outline 4 things and they look rather heartening to hear. So CAD is under control, fiscal deficit has been reined in, inflation is beginning to soften, and growth is just about beginning to pick up. It looks like the patient is out of ICU, well in the ward, if I may, but At this stage, from a North Bloc perspective, what would you expect the RBI to do? In his speech, however, Mr. Chidambaram did nudge the RBI to begin easing their monetary policy stance. He did say that high growth aims will have to budget in for moderate inflation. Obviously, nobody likes the Arijit Patel report. What do you expect Mint Street to do next, considering this is a pragmatic account that you have given?
As far as the policy rates are concerned, I will not say anything on that, because that is completely the remit of the Reserve Bank of India, and I believe that they take decisions after deep consideration, and certainly the next decision will also be based on their own understanding of what the ground realities are. Having said that, as the Finance Minister has said in his speech, we believe that the central bank has to do a balance between the monetary stability and also the requirement of growth. And I believe that the governor is focused on both. I think he believes in both. And therefore, going forward, we do believe that there is a case for incentivizing growth.
All right, there is a case for incentivizing growth. Let me get in, Mr. Seshasai, on rates. You were talking about cost of credit. Come in on this. The governor needs to do a balance act. Should the balance now turn in favor of boosting growth than just firefighting inflation? Is the time right and ripe?
Well, you know, corporate India has always been looking for cheap credit, and that's something that we constantly keep shouting about. But while this is certainly a good thing to happen, but I think we must recognize that inflation is a far more serious subject, and the effect of that we are beginning to see in the fact that the savings rate is coming down. If we do not have enough savings rate and we do not have enough capital formation, I can't see therefore investments and growth happening. So in a way, corporate India has to tone down its expectations in terms of lower interest rate. It's got to take its time. And if you want me to answer, is this the right time? I would say, to be very objective, that we have to watch to see that the inflation stabilizes at this level before we begin to ask for more to lower the interest rate.
Candid admission there by Mr. R. Seshasai. Let's throw that question to the banker and the panel as well. Ms. Sharma, will low inflation and low growth now force the central bank to relook at the monetary policy stance, or do you think the RBI will continue to focus on CPI and that's likely to be the guiding force, keeping rates high in the near term at least?
So I think clearly in any policy you have to get a balance between growth and inflation. What the Monetary Policy Committee report talks about is that CPI is going to be the focus, and I don't think you can really argue with it as a long-term direction. It's more a question of how you navigate to that point and how do you make the balance between killing growth, killing employment, and living with a bit of inflation. So I think RBI is probably going to watch whether we are moving in the right direction. Again, you can't target very specific numbers, but I think direction is definitely going to be important in shaping any policy.
Mr. Mairam, could I come in with a question on infrastructure? It seems to me that one of the really big crises facing the country is a crisis of infrastructure. We had gone in on the presumption that the government doesn't have enough money, so we will go the private path. There will be a lot of PPPs. Many of those private sector companies came in, they invested a certain amount. Today, a very large number of them are in serious financial trouble. In many other countries, they would have been declared bankrupt. So that availability of the private sector and that equity has disappeared for a number of reasons. Over-optimistic bidding or lack of growth, a number of reasons. So that particular infrastructure model that we were following is broken. We have the situation where, shall we say, the IDFC was set up to fund infrastructure. And Mr. Rajiv Lal says, I see no prospect of funding infrastructure, so I want to convert myself into a bank. I mean, a terrible kind of confession out there. So the one way out, lots of the infrastructure people I have talked to, they say, look, we can no longer take the equity risk and the loan risk because there are all kinds of delays. We would just like to do EPC projects. The government will have to come forward with the equity, and we will then do the servicing of those particular contracts, but don't ask us to take on the equity risk or to take a large number of loans and expect we'll be able to pay it off. We've seen what happens. Clearances don't come, the land acquisition doesn't come, the model is broken. So let the government go back to very, very massive investment, and we will just do EPC contracts. Do you agree that this is the way forward? Because if this is the way forward, the budget will have to find far, far more money for infrastructure than has been the case in the last 5 years.
I think we need to look at it in a more granular manner. It's not like a this or that approach. Certainly, when we started off the public-private partnerships when the growth was very high. It appeared that everything will move in the positive direction for many, many years. Nobody predicted that we will have a global downturn, a meltdown, and therefore we will run into these kind of problems. So our concessions or the contract documents were also so designed that they were very rigid and de-risked to a very great extent the government or the public sector, and therefore the private sector had to take on a little more risk than what perhaps in difficult times they were capable of taking. So therefore we understand that there will be areas in which perhaps more EPCs will have to be done. But at the same time, I don't think that the public-private partnership framework is a broken arrangement. What we need to do is to quickly reinvent part of it, which we have already started doing. For instance, renegotiating the concessions, deciding how the stress is coming in, where the responsibility is that of the public sector in terms of delayed approvals, etc. The risk has to be taken by the public sector. Where it is a problem of the management or lack of finance on the part of the promoter, we need to create a framework where they can exit. It is already beginning to happen. And we have seen that there is a lot of interest in private equity entities and pension funds, etc., to move into that space. We are presently also looking at the other models of pooling of investments through infrastructure trust models, where the investors, long-term investors, pool in their investments, and these can then in turn flow into the infrastructure sector, especially in the stressed projects. I think a lot of work is going on which is not seen, and therefore we will see going forward a much more sophisticated way of dealing with these rather than a very vanilla kind of a contract that we were into till now. And I do believe that there will be still a lot of space for private sector to come into infrastructure, but we will have to expand the private sector in terms of their participation. If you look at the infrastructure space, you would see, for taking up large projects, the number of private sector companies is rather limited for a scale of investment that is required, and therefore we need more players to come into this space. More players from within the country, more players from outside, and we will need to work towards getting them into this space. So I would once again affirm that whereas we will need also to look at the EPC route, but at the same time I do not believe that the PPP framework is broken.
All right, the PPP framework is not broken, and India Inc. needs to be very much a part of the growth story. Dr. Mairam, we thank you very much for being with us. We know you've had a really long day and some rather sleepless nights. Thank you very much for being with us on Agenda 2014 this evening. I want to take a quick final comment from Mr. Seshasai before we move on to the political debate. And Mr. Seshasai, a lot of people in India Inc. who we've been interacting with since morning believe they're going to wait and watch what the outcome of elections will be. According to you, do you believe the fault lines still remain and it is really onto the next government to sort things out? It will really be a political will more than an economic mandate, so to say, to fix the fault lines, if I may?
100%. I think we have been talking for a long time that good economics is good politics, and I think we now have a situation where it is good politics being a precondition for good economics. So unless we sort out our political chaos, and unless we have some stability, and unless, by the way, we have a model that is capable of delivering growth at 8%, capable of inviting private capital without slipping and becoming vulnerable to crony capitalism, and the model that is also inclusive all at the same time. And I think we really need to reimagine this kind of a model that's not there at the moment. I really think that we can't move forward. So politics is going to be 100% important.